Welcome back to the Isn't That Rich podcast. Today we are talking about FDIC insurance and how you might be insured more than you think depending on how you structure your accounts. Today we've invited Christine Hankins, our president of retail banking, on to tell us all about that because she is the one who typically handles that within our bank. So welcome on, Christine.
Thank you so much for having me.
Yeah. So Christine, for those who don't know what FDIC insurance is, can you maybe start us off by talking about that a little bit?
Absolutely. I would love to. So FDIC insurance covers depositors' accounts at each insured bank, dollar for dollar, including principal and any accrued interest through the date of the insured bank's closing up to the insurance limit. So per depositor.
Okay. So that means if I put my money in a bank, that money is insured up to $250,000.
That is.
Okay.
Yes.
Dollar for dollar.
Dollar for dollar.
And today we're going to talk about why there's another side to that, because we think that it's only $250,000, but there are things you can do to make sure you're insured even more, right?
Correct. Yes.
Okay.
Yes.
I think it's interesting what you've been talking about a lot lately with customers will spread their money out amongst different banks because they think that they can only be insured up to $250,000 at one single institution, and that's not correct.
Yes, that's correct. So you can be insured for well over $250,000 up to millions, depending on how you structure those accounts. It gives customers peace of mind to be able to bank with one bank and still be insured for all of their money at one bank. And so, it's a great topic to talk about.
Because I would hate if I, went to a bank and then something happened to the bank and I couldn't get all my money.
Yeah.
That was my hard-earned money.
Yeah.
Right.
So.
And has that ever happened before? If a bank is insured, have they ever lost money?
FDIC has never lost a penny on insured money. And so that's amazing.
Yeah.
And so, very important when you're looking to depositing your money, because there's lots of places that you can go to making sure that you are FDIC insured.
Yeah, because there are a lot of online accounts. We talk about this and we can get more into detail later, but there are some online, not necessarily banks, where places that you hold your money that might not necessarily be insured. And we're going to kind of get into that later on. Yeah. So FDIC insurance, what does it cover? I mean, just checking accounts, or are there other types of accounts that you have in a bank that are insured?
Yeah. Great question. Savings accounts, certificate of deposits, IRAs, lots of different money markets. Of course, if a bank issues a cashier's check and you've not cashed that, that is also insured. So lots of ways and different products that you can deposit your money into besides a checking account and be FDIC insured.
Got it. So savings accounts, checking accounts, CDs, money markets accounts,
business accounts.
Business accounts. Okay. That's good to know. I wasn't sure if it worked the same way for businesses. So
Yes.
that's good. Mm-hmm. Well, good. Well, what doesn't FDIC insurance cover? So we were talking about other accounts that might not cover if it's not at a bank. So what else would you think?
Investments, stocks, bonds, mutual funds, life insurance policies.
Ooh, I didn't know that. Life insurance policy is not insured. So you put money all the time into your life insurance policy and it's not insured by the FDIC.
Right. So this rate environment that we're in, a lot of people are being marketed these high interest rates. These might be online banks. They might be other financial, institutions, but not all of them are going to be FDIC insured. So there's lots of places to put your money. There's lots of attractive rates out there, but you definitely want to do your research and make sure that you are insured. So you have that peace of mind because you work so hard for your money your entire life. You want to make sure that it's protected and it's safe.
Well, when you say that, what about retirement accounts like IRAs, that kind of thing? Are those FDIC insured?
Right. At our bank, the IRAs that you can open are FDIC insured.
Okay.
Of course, an IRA is an individual retirement account and it can be held in many different forms. So it can be held in mutual funds, it can be held in stocks, bonds, all of the things. And so depending on what it's held and where it's held at will determine that. But if you have an IRA at Farmers State Bank, it is FDIC insured.
So good to know.
Yeah.
I think it's interesting that there, in recent years, we've had a lot of like online banks come out, and like you said, they'll offer higher interest accounts. They'll offer a higher rate because they don't have the overhead that we have at our community bank, with people sitting in there. And you really have to watch some of that stuff because you never really know where you're putting your money into. And so I would look for that symbol when you are going somewhere, you're online poking around, looking at stuff.
Yeah, absolutely.
For sure. So I'm ready to kind of get into like the structure of accounts and how you can structure your specific accounts to be insured for over that $250,000. So what are the different ownership categories that we can talk about? I mean, the first one is your basic, right? Your single ownership.
Yes. So, single ownership. So if I have an account in my name only, I do not have a joint owner. I do not have a beneficiary. It's not IRA money. It's just a basic checking account in my name only. I'm insured $250,000.
Okay. So that's kind of where that original number comes from is you, Christine Hankins, have an account, single ownership, nobody else benefiting from that account. It's yours. That's a single $250,000.
Yes.
Insured. Okay.
And what we're getting at is FDIC insurance allows you to be insured up to millions as long as you are in different categories. And so we're going to go through each category, and we can use me as an example if you want.
Yeah, let's
do
that.
Go through each category and see how much I could be insured at our bank.
Yeah, I love that.
Like as an example. Perfect.
So if you, Christine, were a single, we talked about it, it's $250,000. Is that account for if Christine had any type, savings, checking, that's all under, like you can just by yourself without any other beneficiaries have several different kinds of accounts, right?
I love that you brought that up. Yes. So I could have 10 different accounts at our bank.
Okay.
All in my name only, and it would all fall under that category. And I could have 250 combined that balance between all 10 accounts and be insured.
Okay.
So multiple accounts. You can have multiple accounts in the same category.
Okay.
Yes.
And so in the same category for a single account, it would be a money market account, a savings account, a CD, and a checking account.
Yeah.
Right?
You could have all of those in my name only and be insured up to $250,000 combined balances with all those accounts.
So that category you keep talking about, that's kind of what's in that chunk right there.
Yes.
Those.
Gotcha.
Okay.
And the next category is the joint.
Okay.
So I can have a joint account with me and my husband, and that would be insured $50,000 or $500,000, $250 per owner. Okay. And so if I had 3 owners, it'd be $750,000. So each owner is $250,000, and that would be considered that joint category. So I could have my single ownership for the $250,000, and then I could have a joint account with me and my husband for $500,000, and so we could be insured for $750,000 total.
Right.
Combining the 2 categories.
Wow.
So if you had a joint account and you had a husband and wife, and so that means they're $250,000 apiece, so $500,000 total. What if they have $1 million in the bank? They're only insured for the $500,000. They're uninsured for the other $500,000.
Correct.
So I'm excited to talk about some ways that we can insure the rest of it.
Yes.
But 2 owners, $250,000 a piece. That's what that looks like. And so in the joint account category, we've got money market accounts, savings, and CDs, correct?
Yes. In checking.
And checking.
Yes.
Gotcha.
Yes.
So you can have any of those accounts as a joint owner, right? So you and your husband can both own those accounts.
Yep.
Okay.
So we get
It gets complicated. I mean, there's a lot of different, and language that we use. Like we'll get into it, like beneficiaries, POD, joint account. So it's important to know what each one of those means.
So what's great about that, because it gets a little complicated, you can go out to FDIC website. They do have a calculator. You can put in all the accounts that you own with the ownership and the dollar amounts, and then you can calculate to see if you're insured or not. You can obviously come to Farmers State Bank, and we would love to sit down with you and do the same with you. And we have done that with multiple customers. And I like to do that because that just backs up what we're saying, so our customers can leave and feel comfortable. If that's a concern of theirs, that's an easy solution and a way to put it on paper.
I just like the visual of that, because for me, it's hard to understand or comprehend when somebody's telling me, no, you really are insured up to this amount, but I can't see it.
Right.
So I think that's an excellent way to actually make a visual for someone.
Yeah.
Because that's how I learn, is visual learning. So
A guy came into the bank yesterday and was talking to Danielle about it, and he was just throwing all these rules at her. He's like, heard these new rules, and we're like, no, nothing has changed with the FDIC.
Yes.
But people come in all the time and ask questions about it and are really concerned. So I'm glad we're talking about it.
Yeah, absolutely.
So is there anything else about a joint account that you would want listeners to know, or should we do an example of what that could look like? Or do you think that was already pretty well?
I think, just so you know, each joint owner is 250. So if you have 4 or 5 owners, you're going to do number of owners times 250 as your insurance. So it's pretty simple. And that is a separate category than those single and other categories we're going to talk about today. Okay. So that's additional insurance that you would be insured.
Okay. I didn't even know you could have 5 people as a joint owner of an account. So that's really good to know too.
Yeah.
I have a question. I want to make sure I get this right too before we move on. It's the insurance is per category, correct? Not per account.
Correct. Absolutely.
Does that make sense? So if they if this joint account, this husband and wife had $500,000 in a checking account, in a joint checking account, and then $500,000 in a savings account.
Right.
Those are the same category
It's the same
that they're
category.
in, so they're not covered yet. We're going to get them there.
Yeah. Right.
Okay.
Right.
Makes sense.
I think it's important to me when talking to a customer, ultimately, how do they want, we like to make sure that we have their accounts structured how they want them. So the ownership, beneficiaries, however they want it, you're never going to add owners or add beneficiaries to get FDIC insurance, because ultimately, I don't want to add you guys as an owner to my account for FDIC insurance.
Right.
And then you have access to my money. You know, you're not just going to add. So we always ask
Let
those
me add all my
questions.
best friends to my account. Yeah, you don't want to do that.
You don't want to do that. So we're going to ask a lot of questions at account opening. When something were to happen to you, who do you want to have your money? Do you have a will? Do you have a trust? Who needs access to this money while you're living? Do you have beneficiaries or power of attorney, authorized signers, all of those things? So we want to really get a good idea of how we should title your accounts based on what you want to happen. And then we'll look at FDIC insurance.
Okay.
If we have somebody that's uninsured, but it's titled correctly, because ultimately while you're living, you want it titled correctly, then there's other products that we'll talk about at the end that we can still get you insured to millions using other products that we have inside our bank.
Without having to add all your best friends on your account.
Right.
Gotcha.
Right.
Okay.
Right.
Okay.
Right.
Well, I feel good about that one. So the next category is revocable trust accounts.
Right. So,
Explain more.
I don't even know what a revocable trust is, or listeners
so
might
confusing.
not know what that is.
Right.
So first of all, what is that? And then...
Right. So a revocable trust is a document that if you title your accounts in that trust name, that it's very specific about what happens to your money and when. So a trust essentially can never die. You would appoint successor trustees, you would list beneficiaries in that trust, and you can be very specific. It doesn't have to just be bank accounts. It can be actual items maybe that are very important to you, maybe a wedding ring of your grandma's, or a special watch, or tools, or a home. You can go on and on and on. So you can be very specific in a trust, and you can also title your bank accounts in that. Beneficiaries are put inside that trust, right? So trust is very similar and in the same category in FDIC insurance as a beneficiary or a POD account, payable on death account. Okay. So those two categories are combined.
Okay.
And the way that works, it's number of owners of the trust or the bank account. So if I have a trust and me and my husband both own that trust, we're co-trustees, living trustees. We both own that. And we have our 3 kids as beneficiaries in our trust. or we just have a joint account. We don't have a trust. We've never went to an attorney to do a trust, but we have a joint account with Farmers State Bank, and we have our 3 kids listed as beneficiaries payable in death. And something that happens to both of us, it pays to all 3 of them. It's going to be the same category with FDIC insurance.
Got it. That's important to know, because the joint is just you and your husband's without any PODs or payable upon death. And then, the POD account is the same. A checking account is the same category as the trust.
Yes.
If you do have those beneficiaries.
Yes. Okay. And in that category, the way you figure it, it's number of owners times number of beneficiaries. So if you have 2 owners and 3 beneficiaries, that account would be insured $1.5 million. $1.5 million, because you would have $500,000 per beneficiary, because I've got 2 owners.
Okay.
So $250,000. So if I have my daughter and she's a beneficiary, she would be insured, $250,000 per owner, that one beneficiary. Okay. So $250,000 for mom, $250,000 for dad.
Got it. So daughter has $500,000 because mom and dad
have $250,000 apiece.
Got it. Okay.
And if I have 2 other children, they would be the same. So that's where you get the $1.5 million. So if husband and wife have a joint account with 3 beneficiaries, all of their accounts, so say they have 5, they have checking, savings, CDs, they're all titled the same way. They all fall in that same category. Combined between all those accounts, they are insured at our bank $1.5 million. It's awesome. That's just a misconception that a lot of people think it's $250,000 per bank.
Right. That's
what they think.
Well, that's what you hear.
Yeah.
That's what you hear all the time.
So they think I need to have $250,000 in this bank and $250,000 in that bank and $250,000 in this bank. And then that's really hard to manage, to work with 4 different banks. And then think about later down the road, something does happen to you. It's hard for your kids to manage too. It's nice to have the peace of mind to be FDIC insured with one bank. So you have peace of mind, but it's also easy to manage to work with one bank.
Yeah.
So,
and this makes it ease of mind.
Right.
I mean, being insured for that much.
Right.
Very cool. So after the revocable trust is irrevocable trust. So that's different.
So that is different. Right. And that is a trust that you cannot change. And the person that's in charge of that trust is not the beneficiary. So if I own the trust, and I have an irrevocable trust, I would have you maybe manage that trust.
Sure.
And you're not the owner, but you're managing it. But that can't be changed. So a lot of times trusts will be changed because your life changes throughout the years. So you might go change your trust. An irrevocable trust, you cannot change. Okay. You'd have to do like a brand new trust. Okay.
Got it.
So that's the difference. But it's insured separately.
Okay. Very cool. So you could structure that the same way, and it would just, as you talked about before, it would just be in a irrevocable trust.
Correct.
Got it.
Yep.
Okay. What about retirement accounts? We kind of brushed on that. IRAs.
Yes. So retirement accounts are $250,000 per bank per IRA. So my husband could have an IRA for $250,000. I could have an IRA for $250,000 and we'd both be covered.
Okay.
And that's an additional on those single joint PODs trust. That's additional money that could be insured. But it is $250,000 per owner per IRA. But IRA is a separate category. Okay. So that's good news.
Yeah, that is.
Yeah.
For sure. What about businesses? We kind of touched it a little bit. What about businesses? How does that work?
So business is also $250,000 per business. So I could, though, own my own business and have a LLC or a corporation, and that would be insured for an additional $250,000.
Okay, let me ask you this. So say my business, I have a partner and we're co-owners or joint owners on this business account. Do we each get insured $250,000 or just the business itself?
The business, that tax ID number, it's per tax ID number.
Okay.
So if you have an LLC, it's $250,000. If you have 10 owners, it's $250,000.
Okay.
Yeah. Yeah. But the cool thing is we have other ways to insure businesses as well.
That's good to know.
Yes. So we have a company called Intrify Network, and they are a third-party company. They do work with over 2,000 community banks, local, big banks, small banks in the United States. And they have been working with them since the Clinton administration, so a long time. And so this is not a new thing. And we partner with them, and it has been really successful at our bank for many years. So you can deposit personal and business. You can do personal and business, but definitely this product is a way for the insured to be able to be insured for millions. There's no limit. And so a business, this would be a great opportunity for a business to do this. We have a lot of public funds that do that. And it's a way for them to for sure have peace of mind and not have to work with 15 different banks to be insured because, auditing wise, they have to be insured. A lot of those, a lot of public funds for sure do. So this is another way that they can have peace of mind, but also work with one bank. They can earn interest. The products that are available with the Intrify are both checking and CDs. And so, it's something that we've done for a long time. And we can, if you're not wanting to title your money all of these different ways, maybe you don't have 3 beneficiaries, you don't have a joint owner, you're just a single person that needs insurance. We can use this product and be successful with getting you insured. So it's another opportunity.
This made me think of a question. Well, you said people, so I'm thinking about somebody that doesn't have anybody. I remember reading earlier something about like if people want to leave their money to a charity, if it was just me and I wanted to leave all my money to St. Jude, is St. Jude covered for $250,000 on my account?
Yes. Charities. Yes. That is a qualified beneficiary that you can use for coverage. Yes.
So that's interesting. That's another way you could,
and
we wanted it to go there. You could add that on, and then you would know that was additional
and
insurance.
We have people that do that.
Yeah.
We have a customer that I can think of right now, but so that's an option.
Oh, okay. Very cool. And the Intrify accounts are interest bearing, correct?
Yes.
On the whole shebang.
Yes.
So it's not like our CASAS. It's not just like our CASAS where it's up to 10,000 plus the rest of your savings, but it's the whole thing. So it's FDIC insured and interest bearing.
Yes.
Does that interest rate change?
It can
fluctuate.
So we have 2 different products that we use with Intrify. The CD product would be a fixed rate, and so it would be stay the same, but our checking account is a variable rate, so it could change.
So, are there any limitations to this? I can't just put 30 beneficiaries on one account, right? And get them all insured. Could you imagine?
Right. Yes, absolutely. There are limits. So if somebody has more than 5 beneficiaries, then we would just call the 1-800 number to FDIC, why that customer's right at our desk, if that's a concern for them. And we would just tell them exactly how the accounts were titled, how many beneficiaries, and find out the maximum insurance. And they are so good on the phone. You can get a live person. They will walk you through it and get your answers and have your customer right there. And so everybody feels, at peace of mind. And we will absolutely do that and have done that. So if they have more than 5 beneficiaries, that is the route we would take. We would just pick up the phone and call them.
Okay.
To make sure.
Big families with 5 kids or more. You probably want to.
Yeah.
I'm thinking, what if someone has 7 kids or something?
Yes. I'm thinking about my grandparents. There's 11 kids in that family. That's huge, right?
Yes.
What do you?
There's 3 of us. I'm like, I hope my mom and dad have me on the account.
And so what
definitely as a beneficiary, you know.
What I remember in the past is as long as they're qualified beneficiaries. Yeah. So FDIC tells you what's a qualified beneficiary, and a child is absolutely a qualified beneficiary. So if you've got 10 children, I'm betting that you're insured for $250 per owner, just like that. But it does get a little bit tricky. And so that's why we would call. But they definitely have, they have what's called a qualified beneficiary. So you can't just be adding your neighbors and just random people to get insurance for 30 people or whatever.
Gotcha.
Well, and I think it's funny. We have this conversation that we're people are going to be dying to just add all these people to their account. But 99% of the time, nothing is going to happen to your money or the bank. I mean, we've seen this recent scare with Silicon Valley, but that was like 1 in a million. But it's good to know that this is available to us.
Right. I think it's just great for our customers to have peace of mind. And I think it's good questions to ask. And yes, the likelihood of it ever happening is very slim, but it's good to be prepared. And that's with everything with your finances. You need to, if you are listening and you don't have beneficiaries or you have questions about the way your accounts are titled, maybe FDIC insurance isn't what you're concerned with, but maybe it's if something were to happen to you tomorrow, you be in a car accident, you want to make sure that your account is titled and the people that you love and want to take care of your accounts are named. We would love to talk to you about that and make sure that that is structured the correct way, because we can add beneficiaries at any time to any account.
Okay. So you can change it after something's in place. You can always go back and change it. Because it kind of feels final.
Yes.
To me, like you name this account, you create this account. Now do I have to close it and create a new one? Like what is,
Right. So you can add beneficiaries today, and 10 years from now, 5 years from now, next month, you can change those beneficiaries. It only requires you walking into the bank, signing a signature card, and us having a conversation to make sure that we have it the way you want it. So that's not... It can be changed at any time. And we like to have those conversations with customers because it's important to us that we know their future is taken care of and they have things set up. It makes it easier for their family members and for them. So
that leads me to this question. How often do you think a customer should review their accounts to make sure that they are covered, or just in the right accounts anyway?
Anytime between 1 and 5 years. I think a lot of times if you have a trust, they say, take a look at that every 1 to 5 years. I mean, things change, life changes, and you do want to make sure you have your finances in order. So we would love to sit and talk to you about your goals and your future and how that changes over time. That changes from your 20s to your 30s to your 40s to 50s, 60s, but you always want to be thinking about it. So
things change fast. I mean, things happen in a year that you wouldn't expect. So I think it's important.
Well, I'm thinking about how I'm going to win the lottery and I'm going to have all this money going to my account. I really want it to be FDIC insured. So I need to come sit down with you, Christine, don't I?
Right. So I know we have these pamphlets in our lobby, and I think they're a really good resource for people. And I think most banks have this.
Yes.
But where can people go for more information? It's kind of all written on here. But
yeah, absolutely. But you can go to www.fdic.gov, and that's going to link you. That calculator is on there. There's all kinds of good information on there. We can give this to you in our bank lobby and talk to you about it as well. So
that's awesome.
The marketing department has them fully stocked out in the lobby.
That's great. Any last things you would leave with our listeners?
No, Christine? I just think don't be afraid to come in and ask questions, even if you're not going to make any changes. If you have any questions at all, we'd love to sit down and talk to you at any of our locations. I do think it's important to not only be FDIC insured, but also to have your accounts titled properly and the way you want them. And so a lot of people come in saying they want certain things and they come out with it differently. And so it's just good to have conversations to make sure they're set up correctly.
Absolutely. Well, thank you so much for answering all these questions. It's complex. So
yes, thank you.
So much fun.
It was fun.
Good.
Thank you. We'll see you next week.
So Jill, where do we go from here?
Be sure to check out our show notes for this episode, and also be sure to follow us on social media and subscribe to our newsletter. We'll see you next week.
See you next week.